I'm joined now by Derek Halpenny, the European head of global FX research at the Bank of Tokyo-Mitsubishi. So first of all, I want to start by asking you about the comments that we were hearing from the Czech president there that a euro breakup is out of the question.
Yeah, I would agree with that. I think the idea of a breakup is certainly more realistic today than it was pre-crisis. But I think the key for the markets shorter term is the ability of the countries under most fiscal pressure, whether or not they have the ability to consolidate their fiscal positions or whether they will have to restructure their debt in some way. And I think the markets are still pricing certainly for Greece having to do that. And I think certainly from a confidence perspective, that would be extremely damaging for the euro, whether or not the idea of a breakup is realistic or not.
But is a weaker euro necessarily a bad thing for the region?
No, absolutely not. I think it's one of the reasons why we're bearish for the euro. I think it's one of the helpful additions to achieving what is required going forward. But, you know, I think we have a forecast for euro-dollar of 110 in 12 months, and that's certainly not on any view of a threat of a breakup to the single currency. But I think what it does show is that the European economy is likely to weaken, especially in 2011, as the fiscal position.
The euro is headed for parity with the dollar?
Well, I think parity is a close call. I'm not so sure we'll get down to those levels, but certainly I think something between parity and 110 in 12 months' time is certainly very realistic.
And there seems to be a consensus, or at least many analysts are saying that longer term, this is where we're heading, this is the underlying trend, and yet recently we seem to have been seeing something of a rebound in the euro.
Yeah, well, I think certainly the rebound is simply explained by possibly the excessive move to the downside. There was certainly a very extreme amount of bad news priced in, and the actions from the ECB in recent weeks does appear to show that the removal of liquidity is not having any adverse impact on short-term yields, and less banks are going to the ECB for assistance. So I think there is some justification in this short-term rebound, and the IMM data does show that speculative positions have been unwound quite dramatically over the last 2 to 3 weeks.
And Derek, what do you make of the argument that in the next 6 months we will see something of a turning point as traders focus on economic frailty in the US?
Well, I think that is part of the excuse for the dollar weakening recently. I would disagree to that. I think certainly the likelihood is that going forward from here, we're going to see disappointing growth in the United States for sure, and that's becoming more evident than elsewhere at the moment. But of course that's going to spread globally, and I think what we're in for in the second half of this year is a period of investors' concerns about the threat of further disinflation and possibly deflation coming into the global economy, certainly into the United States, and we'll have data on that this week which will show disinflationary pressures. And in those circumstances, investors are going to go to where there's liquidity and perceived safety, and for me that is the US debt market, and that's where we're going to see the flows going. And the reverse of that is the debt demand in the Eurozone has dropped dramatically.
Well, thank you so much. Appreciate your insight and analysis. Derek Halpenny, European head of foreign exchange, Bank of Tokyo-Mitsubishi.